So now let's start off with an intro to managerial accounting with chapter 1. So what is managerial accounting? Well, this is providing accounting information for a company's internal users, and it has three broad objectives: planning, controlling, and decision making. So the objectives of managerial accounting is to provide information for planning the organization's actions, to provide information for controlling the organization's actions, and to provide information for making effective decisions. So, but then what is planning? Well, this is the detailed formulation of action to achieve a particular end. So, setting objectives, identifying methods to achieve those objectives. For example, improving quality. In that case, you might have to set up a supplier evaluation program. But then what is controlling? Well, controlling is monitoring a plan's implementation and taking corrective action as needed. So compare actual versus expected performance. And then what about decision making? Well, decision making is the process of choosing among competing alternatives. So alternative 1 versus alternative 2. So now let's take a look at financial versus management accounting. So financial accounting is focused externally. So it must follow externally imposed rules. It has objective financial information, and it has a historical orientation, right? It looks at the past, and it has information about the firm as a whole, and it's more self-contained. But then we look at management accounting. Well, management accounting is internally focused. There's no mandatory rules, and it contains objective financial and non-financial or subjective information. And the emphasis of management accounting is on the future, and it involves internal evaluation and decisions based on very detailed information. And management accounting is broad and multidisciplinary. So essentially, financial accounting provides historical information for external users such as creditors, investors, customers, suppliers, SARs, etc. So the financial statements must follow rules set by the SEC, so the Securities Exchange Commission, FASB or ISB, right, International Accounting Standard Board. And then managerial accounting produces information for internal users such as managers, executives, workers, etc. It identifies, collects, measures, classifies, and reports financial and non-financial information to internal users in planning, controlling, and decision making. So, but then what is the role of a managerial accountant? Well, they play a support role to those who are responsible for carrying out the organization's basic objectives. So the line positions. So the managerial accountant is a staff position, meaning they're indirectly responsible for the organization's objectives. And then the line positions is when you're responsible for carrying out the organization's basic objectives. So the CFO, or the Chief Financial Officer, supervises all accounting functions and reports directly to the GM, General Manager, and the COO, Chief Operations Officer. And then the treasurer is responsible for the finance function in raising capital and managing cash and investments. Now we move on to basic managerial accounting concepts with chapter 2. So what is cost? Well, cost is the amount of cash or cash equivalent sacrificed for goods and or services that bring a current or future benefit to the organization. So it's essentially the amount of cash that you sacrifice for goods and services that bring a future benefit. So costs are used up in producing or generating revenues. Therefore, they expire. So expired costs are essentially expenses. And obviously you should know that profit is equal to revenue or income minus expenses. And then price is the revenue per unit. So accumulating costs are the way that costs are measured and recorded. For example, a phone bill is recorded, then it goes to the accounts payable and telephone expense account. And then assigning costs is the way that a cost is linked to some cost object. So the objective or goal of the cost or expense. For example, for manufacturing or to help sell the product. So cost is assigned to a cost object, which is the objective or goal of the cost or expense in the first place. So essentially, managerial accounting systems are structured to measure and assign costs to cost objects for accuracy. So a cost object is any item such as a product, customer, department, project, geographic region, or plant for which costs are measured and assigned. So then what are direct costs? So these are costs that can be easily and accurately traced to a cost object. So if the cost is easy to trace, the relationship between the cost and the cost object can be physically observed, easy to track, and results in more accurate cost assignments. But now let's talk about indirect costs or overhead or support costs. These are costs that can't be easily and accurately traced to a cost object. So this is where we get to allocation. So an indirect cost is assigned to a cost object by using a reasonable and convenient allocation method or basis. So we usually allocate these indirect costs. But now what is a variable cost? Well, a variable cost is one that increases in total as output increases or decreases as output decreases. So it varies with the level of output or production. But what about a fixed cost? Well, a fixed cost is a cost that doesn't increase or decrease in total as output increases or decreases. So it remains unchanged as output or production changes. And then what is an opportunity cost? Well, an opportunity cost is the benefit given up or sacrificed when one alternative is chosen over another. So then what are products? Well, products are goods produced by converting raw materials through the use of labor and indirect manufacturing resources, like a manufacturing plant, land, machinery, etc. And then what are services? Well, these are tasks or activities performed for a customer or an activity performed using an organization's products or facilities. So services are intangible, perishable, and they require direct contact between the providers and the buyers. So managerial accountants must decide the types of managerial accounting information to provide to managers, how to measure such information, and when and whom to communicate the information to. So when managerial accountants provide outside parties with cost information, it's usually a balance sheet, so a balance of closing inventory, and the income statement, so cost of goods sold. This is where managerial accountants must follow specific external reporting rules, like GAAP, General Accepted Accounting Practice. So this is the one exception where they have to follow these outside mandated rules. Usually they don't have to. So to calculate closing inventory and cost of goods sold, costs are subdivided into functional categories: production costs and period costs. Period costs are essentially non-production costs, like the selling or administrative expense. So what are product or manufacturing costs? Well, product costs are both direct and indirect costs of producing a product in a manufacturing firm or of acquiring a product in a merchandising firm and preparing it for sale. So product or manufacturing costs include direct materials, direct labor, and manufacturing overheads. So if they ask you what are product costs, it's essentially the direct materials, DM, the direct labor, DL, and manufacturing overheads, MO. All three of these constitute product costs. Product costs are inventoried and remain in inventory until sold, at which time they're transferred to cost of goods sold. So let's take a look at the different things that make up product costs. So direct materials. What are direct materials? Well, these are materials that are a part of the final product and can be traced directly to the goods being produced. So the materials cost can be directly charged to products because physical observation can be used to measure the quantity used by each product. For example, wood in a dining room table, or the types of a car, lithium battery in a phone, whatever. Now let's take a look at direct labor. So this is the labor cost that can be directly traced to the goods being produced. So again, physical observation can be used to measure the amount of labor used to produce a product. For example, wages for employees who convert direct materials into a product are classified as direct labor costs. But then we also get indirect labor costs. So the indirect labor costs are included in the manufacturing overhead and is therefore an indirect cost rather than a direct cost. For example, the plant supervisor's salary. So now let's take a look at the last part of the product cost or the manufacturing costs. Manufacturing overhead or factory burden or indirect manufacturing costs. So manufacturing overhead is essentially all the production cost or all product cost other than direct materials and direct labor. So all product or manufacturing cost other than direct materials and direct labor are considered manufacturing overhead. For example, depreciation on PPE, janitorial and maintenance labor, plant supervision, materials handling, power for plant utilities, plant or factory property taxes. So essentially, all the costs that are involved in producing the product other than direct materials and direct labor is manufacturing overhead. So including the indirect labor costs, depreciation, equipment, depreciation, etc. So but then how do we calculate the total product cost? Well, the total product cost is equal to the direct materials cost plus the direct labor cost plus the manufacturing overhead cost. Pretty simple. DM, DL, and MO. What is the product cost per unit then? Well, the product cost per unit is equal to the total product cost divided by the number of units produced. So, but what is a prime cost? Well, a prime cost is equal to the direct materials plus the direct labor. This is the prime cost, the direct materials and direct labor. But then what is a conversion cost? Well, the conversion cost is the direct labor plus the manufacturing overheads. So the direct labor and manufacturing overheads is basically what turns the materials into an actual final product. So the production costs are assets carried in inventories until the goods are sold. So the production costs are essentially the value added to get the final product. All other costs not part of the product costs are period costs. So essentially all costs other than the direct materials, direct labor, and manufacturing overhead are period costs. Period costs are expensed in the income statement in the period in which they're incurred. So we use the accrual accounting principle. So if a period cost is expected to provide revenues beyond next year, then it's recorded as an asset. So it's capitalized and allocated to expense through depreciation throughout its useful life. So examples of period costs are office rent, office supplies, CEO or supervisor salary, advertising, and selling and administrative costs. So under the period costs, some of the biggest ones we have is the selling costs and the administrative costs. So what are selling costs? Well, selling costs are the costs necessary to market, distribute, and service a product or service. So order getting, so sales personnel, salaries, commissions, advertising, and then order filling, warehousing, shipping, customer service. And you should know depreciation on delivery trucks is actually a selling cost. And then we get administrative costs. These are all costs associated with research, development, general administration of the organization that can't be assigned to either selling or production. Examples of administrative costs are executive salaries, legal fees, printing an annual report, general accounting costs, etc. So general admin ensures that various activities of the organization are integrated so the objectives of the firm are realized. Now let's move on to preparing income statements. So the first thing we look at is the cost of goods manufactured. So this represents the total product cost of goods completed during the current period and transferred to finished goods inventory. So yeah, the cost of goods manufactured is the total product cost of the goods that are finished during the period and they're transferred to finished goods inventory. So in order to calculate the cost of goods manufactured, it's direct materials plus direct labor plus manufacturing overhead costs plus the opening work in progress inventory minus the closing work in progress inventory. So you have to get the direct materials, right? Direct labor, manufacturing overheads, and then you add the opening work in progress inventory at the start, and then the only thing that you subtract is the work in progress at the end, so the closing work in progress inventory, and that will give you the cost of goods manufactured. But in order to calculate the cost of goods manufactured, you need to have calculated the direct materials used in the period. So in order to calculate the direct materials used or the ending inventory of materials, you get the beginning inventory of materials or the materials at the start of the period plus purchases during the period minus the direct materials used in production. So it's less the materials at the end. So that's how you're going to get the value for the direct materials that you're going to use when calculating the cost of goods manufactured in the statement. So calculating the cost of goods manufactured is one of the first steps in actually calculating the cost of goods sold. So essentially they'll give you a scenario, right? They'll give you the materials, the work in progress inventory, and the finished goods at the start of the month and then at the end of the month. Then you'll have to calculate the direct materials, right? So you have the materials at the start and then you add the material purchases and then you subtract the materials at the end. Then you get the direct materials used, right? And once the direct materials are calculated, the direct labor and manufacturing overhead for the period are added to get the total manufacturing cost for the period. So essentially, to calculate the total manufacturing cost, you know this. You add the direct materials and the direct labor, and then you also add the manufacturing overhead, right? And to actually calculate the manufacturing overhead, they might give you several expenses, and you need to be able to classify and identify them as manufacturing overhead costs. So once you add the DM, the DL, and the MO, you get the total manufacturing cost, and then the total manufacturing cost for the time period must be adjusted to include the inventories of work in progress goods. So you get the total manufacturing cost, then you add the work in progress inventory at the start of the period, and then you subtract the work in progress inventory at the end of the period, and finally you get the cost of goods manufactured. If they don't have any work in progress inventory at the start or at the end of the period, then essentially the total manufacturing cost is the cost of goods manufactured. And then we look at the cost of goods sold. So the cost of goods sold represents the cost of goods that was sold during the period. So it's the value of products transferred from finished goods inventory to cost of sales. So to calculate the cost of goods sold, you add the opening stock of finished goods, and then you also add the cost of goods manufactured, and then you subtract the closing stock of finished goods, and then you get the cost of goods sold. So essentially the cost of goods sold, you get it after adjusting the cost of goods manufactured with the finished goods. So essentially you'll take the cost of goods manufactured, and then you add the finished goods at the start of the period or the start of the month, then you subtract the finished goods at the end of the month, and then you get the cost of goods sold. And obviously you need to know how to draw up an income statement, right? So you're going to have sales, right? And then cost of sales, then gross profit, right? After subtracting the cost of sales from the sales or revenue. And then you less all your operating expenses. For instance, the selling expenses, administrative expenses, and all the other period costs. And then you get the operating income for the year or the profit for the year. So for a manufacturing firm, you're going to have units sold, right? And then a selling price. So you'll multiply the selling price by the units sold to get the sales amount. And then remember, the cost of sales is the cost of goods sold. So you'll have to calculate the cost of goods sold like the way we did before, and then get the cost of sales, then get the gross profit, etc. But then what about income statements for a service firm, not a manufacturing firm? Well, there's no product to purchase like in a merchandising or manufacturing firm. So there are no beginning or ending inventories, and there's no cost of goods sold and gross margins and profit. So the cost of providing the services appears along with the other operating expenses for the company. So for a service firm, instead of having the whole sales, cost of sales, gross profit part, it's essentially just the sales or revenue, right? And then you subtract all the operating expenses. So this could be the selling expenses, admin expenses, R&D, etc. And then you get the operating income for the year. Now let's talk about job order costing with Chapter 5. Let's take a look at the differences between job order and process costing. Well, companies can be divided into two major types. Firms providing similar products or services can use a process costing accounting system, and then firms producing unique products or services require a job order accounting system. So let's take a look at the characteristics of the job order environment. Well, we have customized built-to-order products that fit into this category, as well as services that vary from customer to customer. For example, printing, construction, furniture making, medical and dental services, automobile repair, etc. So a job is one distinct unit or set of units. So the cost of one job differs from that of another job, and the costs are accumulated by job in a job order production system. But now let's take a look at process production and costing, so process costing systems. So firms in process industries mass produce large quantities of similar or homogeneous products. For example, food canning and manufacturing, cement, petrol, pharmaceuticals, chemical manufacturing, etc. So process firms accumulate production costs by process or by department for a given time. And the unit costs are calculated using the process costs divided by the output. And that gives us the unit cost. So if we had to look at a summary of job order costing versus process costing, with job order costing, there's a wide variety of distinct products, costs accumulated by job, and the unit cost is equal to the total job costs divided by the output. And then for process costing, we have homogeneous products, costs are accumulated by process or department, and then the unit cost is equal to the process costs divided by the output. And you should know that unit costs are important because managers need accurate cost information on materials, labor, and overhead when making decisions. So job order costing using the normal cost system will give the company the unit cost information it needs. So now let's take a look at some of the ways to measure the costs of production. So we have actual costing and normal costing. So actual costing is where only the actual costs of direct materials, direct labor, and overhead are used to determine unit costs. But there are some issues involved in using actual costing. The first thing is defining overhead costs. Overhead items don't have the direct relationship with units produced that direct materials and direct labor have. Then we have uneven overhead costs. So many overhead costs aren't incurred uniformly throughout the year. So they occur at different times and amounts. So waiting until the end of the year to total the actual overhead costs is typically unrealistic. And then we have uneven production. So distortions can occur when averages are used with uneven production. So strict actual cost systems are rarely used because accurate day-to-day unit cost information is needed on a timely basis. And we can't wait till the end of the year. So then we move on to normal costing, and this solves the problems associated with actual costing. So normal costing determines unit cost by adding actual direct materials, actual direct labor, and estimated overhead. Overhead can be estimated by approximating the year's actual overhead at the beginning of the year and then using a predetermined rate throughout the year to obtain the needed unit cost information. So we essentially apply the overhead. So what is the importance of unit cost? Well, unit cost is a critical piece of information for a manufacturer. It's essential for valuing inventory, determining income, and making various important decisions. And disclosing the cost of inventories and determining income are financial reporting requirements at the end of each period. And a firm must know the number of units on hand and unit cost to report cost of inventories. And then it's also important for cost of goods sold, so COGS, is used to determine income, requires units sold and their unit cost. And for any product to be viable, its price must cover its full cost. So service and non-profit firms also require unit cost information. And there are also ethical decisions. So non-profit firms must track costs to be sure that they provide their services in a cost-efficient way. And then governmental agencies must track costs to use the funds wisely because they have a fiduciary responsibility to taxpayers. So in normal costing, overhead is estimated and applied to production. So the first step is calculating the predetermined overhead rate, so the POR. And then the second step is applying the overhead to production throughout the year. And then the third step is reconciling the difference between the total actual overhead incurred during the year and the total overhead that you apply to production. So let's take a closer look at the first step, calculating the predetermined overhead rate, the POR. So the POR is calculated at the beginning of the year, and the POR is equal to the estimated annual overhead divided by the estimated annual activity level or cost driver, so the associated activity. So the estimated overhead is the firm's best estimate of the amount of overhead, so utilities, indirect labor, depreciation, etc., to be incurred in the coming year. So the number of machine hours or the direct labor hours or direct labor costs, etc., could be a good choice of activity level or cost driver for the overhead of a company. And the estimates may be based on last year's figures adjusted for anticipated changes in the coming year. Now let's take a closer look at the second step, applying the overhead to production throughout the year. So the applied overhead is equal to the POR or the predetermined overhead rate multiplied by the actual activity level or the actual cost driver. So once this is calculated, the total cost of the product for the period is the actual direct materials and the direct labor plus the applied overhead. So the total cost is equal to the actual direct materials plus the actual direct labor plus the applied overhead that you applied. Now let's take a look at the third step, reconciling the actual overhead with the applied overhead. So you need to remember that there are two types of overhead that are recorded. So the actual overhead and the applied overhead. So the actual overhead is the costs that are computed throughout the year in the overhead account. Then the applied overhead is the estimated costs that are computed throughout the year and added to actual direct materials and labor to get the total product cost. So at the end of the year, it's time to reconcile any difference between the actual and applied overhead and to correct the cost of goods sold account to reflect the actual overhead spending. So the difference between the actual overhead and the applied overhead is the overhead variance. For example, if the actual overhead is $400,000 but the applied overhead is $390,000, the variance is under applied. So the variance is under applied overhead and thus added to the cost of goods sold. And then if the actual overhead is $400,000 but the applied overhead is $410,000, the variance is over applied overhead. Therefore, it's subtracted from the cost of goods sold. So the overhead variance at the end of the year is assigned to cost of goods sold, since the amount is usually small or immaterial. If the overhead variance is material or large, we allocate the variance among ending balances for work in progress, finished goods, and cost of goods sold. So in a scenario, they'll tell you that at the beginning of the year, the company estimated the following costs. So they'll give you the overhead there and then they'll give you something else. Maybe the direct labor cost, maybe the machine hours, maybe the direct labor hours. And essentially you'll get the overhead that they gave you, that they estimated, and you'll divide it by the direct labor cost or the machine hours or the direct labor hours. Be careful not to be confused between them. And that should give you some sort of factor like 1.5 or 0.5, etc. And then after that, they'll give you the actual data that the company recorded throughout the year. So here they'll give you the actual overhead that they recorded, and then they could also give you the actual direct labor cost or the actual machine hours or actual labor hours, etc. And then you'll multiply the predetermined overhead rate that you calculated before, times it by the actual labor cost or machine hours or direct labor hours that they gave you, and then you'll get the overhead that you applied to that particular period. And then for the overhead variance, you'll get the actual overhead that they calculated or that they gave you, and then you subtract it from the one that you calculated using your POR. And then remember, after calculating the overhead variance, you have to adjust the cost of goods sold, right? So if it's under applied overhead, then you have to add it to the cost of goods sold. If it's over applied, then you have to subtract it from the cost of goods sold. But now let's take a look at departmental overhead rates. So the plant-wide overhead rate or single overhead rate is all the estimated overhead for a factory divided by the estimated activity level across the entire factory. So some manufacturers and service firms believe multiple overhead rates give more accurate costing information. So we came up with departmental overhead rates, which is equal to the estimated overhead for a specific department divided by the estimated activity level for that same department. So the steps will more or less be the same but more fragmented. So at the beginning of the year, they'll give you the estimates for the overhead and the hours or machine hours, etc. Then you have to calculate the POR for the specific department on the basis of that specific department's cost driver. So for example, in the machining department, the overhead could be applied on the basis of machine hours, and then for the assembly department, the overhead could be applied on the basis of direct labor hours. And for other departments, it could be based on direct labor cost, etc. And then to calculate the applied overhead, you'll multiply the POR for that specific department according to the actual cost driver for that specific department. And then to calculate the overhead variance for a specific department, it's the actual overhead rate for that specific department minus the applied overhead that you did. And then if they ask you to calculate the plant-wide POR or overhead variance, you essentially get the totals for all those departments. So you get the total overheads and you get the total labor hours or machine hours or direct costs, etc. Now let's talk about a job order cost sheet. So a job order cost sheet is used to keep track of the cost of jobs. So it's the primary document. And the balance in the work in progress at the end of the month will be the total of all the job order cost sheets for the incompleted jobs. So the cost of all the incompleted jobs will fall under the work in progress balance. So what is a materials requisition form? Well, this is a source document where the cost of direct materials is assigned to a job. And you should know that indirect materials like supplies, lubricants, etc. are assigned to jobs through the POR, so the predetermined overhead rate. So indirect materials are within the POR, not to be confused with direct materials. And then what is a time ticket? Well, this is a source document where the direct labor costs are assigned to individual jobs. For example, mileage log, source document to track miles driven. So now let's take a look at how we prepare a brief job order cost sheet. So in a scenario, they'll tell you that at the beginning of a month or a period, they had various jobs in progress. And then they'll tell you that during the month or during the period, these were the jobs that were started, right? That were added on. And then they'll tell you which jobs were completed, which ones were sold, and which ones were still in progress. So essentially, in a statement, you'll have the balance of the job at the start of the month, because sometimes they'll have jobs that were still in progress from the previous period or the previous month. So you'll have the balance at the start of the month for all the jobs, right? Job 78, 79, or how many other jobs. And then you'll have to add the direct materials, direct labor, and the overhead. So they might give you the values for direct materials and direct labor for each job that were incurred during the period. However, you will probably have to apply the overhead. So essentially, you'll have to calculate the applied overhead, so get the POR and multiply it by the actual activity level. This could be the direct labor cost, direct labor hours or machine hours, and then apply the overhead for each particular job. And sometimes you might have to reverse engineer, right? So sometimes you'll have the applied overhead, and then you'll have the actual activity level or the cost driver, but then you don't have the POR, so you're going to have to reverse engineer it to get the POR. And then after having the balance for each job, so the jobs are in the columns and then the direct labor, materials, overhead are on the rows. So after adding up the direct materials, labor, and overhead for each of the jobs, then you'll have the ending balance for each job at the end of the month. And then if they ask you to give us the finished goods statement, you'll have the finished goods at the start of the month, and then you add all the jobs that were completed during the period, and then you get the finished goods at the end of the period or the end of the month. And then if they want the statement of all the work in progress jobs, essentially you'll just add all the jobs that were not completed during the period, that are still in progress. And if they ask you for the cost of goods sold, you essentially just add up all the jobs that were sold during the period. So now let's talk about allocating support department costs to producing departments. So producing departments are directly responsible for creating the products or services sold to customers. For example, the grinding and assembly departments. And then support departments provide essential services for producing departments, but they don't actually make the product or service being sold. For example, the maintenance, grounds, engineering, housekeeping, personnel, or the photocopying department. So once the direct overhead costs of each department are determined, we must assign the support department's cost to producing departments using causal factors or drivers. So there are three methods of assigning costs of multiple support departments: the direct method, the sequential method, and the reciprocal method. So in an example, they'll give you departmental data, right? They'll give you the support departments, for example, the power department or the maintenance department, and then producing departments, for example, the grinding or assembly department. And then they're going to give you the direct overhead costs that each department uses. And after that, they'll also give you the expected activity. Maybe this could be kilowatt hours for the power department or maintenance hours for the maintenance department. So when using the direct method, you'll add up the total kilowatts used by both the producing departments. So maybe the grinding department used 600,000 kilowatts and the assembly department used 200,000. You'll add it together. And then after that, you're going to have to calculate a factor or a percentage by dividing how much that specific producing department used of the kilowatt hours or the maintenance hours or whatever, and then dividing it by the total cost, right? Or the total kilowatts hours used or maintenance hours used. So that'll give you a factor or a percentage. Then you're going to multiply that percentage with the direct overhead cost for that particular support department. And that value is the one that you allocate to the particular producing department. For example, if the grinding department had a factor of 0.75, then the remaining 0.25 will go to the assembly department. So you'll multiply the 0.25 times the 250,000 direct overhead cost for the power department. Then you'll get how much needs to be allocated to the assembly department. So in a statement, you'll have the grinding assembly department there, you'll have the direct cost for them, and then you'll get the power and the maintenance and then the ending balance for overheads. But then we move on to the sequential or step method, and this recognizes that interactions exist among the support departments, but it doesn't recognize all of them though. So the sequence is defined by ranking the support departments in order of the amount of service rendered, from greatest to the least, where the degree of service is measured by the direct cost of each support department. So essentially, the sequential method recognizes that interactions among support departments occur. For example, we only looked at the producing departments, the grinding and assembly, but even the maintenance department can use some of the resources of another support department, power. So the maintenance support department also uses power. So just like the direct method, we're going to calculate the total power used by all the departments, right? Not just the producing departments. So maintenance, grinding, and assembly. Then we'll get a total number. And then we have to get a factor. So we're going to divide the amount of power used or maintenance hours used by each department and divide it by the total value or the total power used or the total amount of hours used. So after getting that factor, we're going to multiply it by the total direct overhead cost for that particular department, right? So it could be 50K to maintenance, 150K to grinding, and 50K to assembly. But now we allocated the power support department's overhead cost to the maintenance department. And the maintenance department is also a support department. So essentially what you have to do is you have to calculate the use of one support department's use of another support department before you allocate the cost to the producing departments. So on a statement for maintenance, you will have had the direct cost for maintenance and then the amount of power that the maintenance department used, and then you get the total for maintenance. And then you're going to still have the total maintenance hours that the producing departments used. For example, maybe the grinding department still used 4,500 maintenance hours as well as the assembly department. So you'll add them together and then you divide the amount that that specific department used up of that total, and then you'll get a factor, and then you multiply that factor by the total overhead cost for that particular department. Then you'll get the amount that we have to allocate to grinding, then you get the amount you have to allocate to assembly. And essentially, you'll have the grinding and assembly department, then you'll have the direct cost, the overhead or the power and the maintenance cost, then you'll get a total. So essentially with a step method or sequential method, you have an extra step because you still have to calculate the total for the support department that uses the resources of another support department. But now we talk about the reciprocal method of allocation. So the reciprocal method of allocation recognizes all interactions among support departments, and it uses a system of linear equations. So now we move on to process costing with chapter 6. So what are the characteristics of process manufacturing? Well, each product within a line passing through the process would receive similar doses of materials, labor, and overhead costs. So process costing works well with homogeneous products that pass through a series of processes and receive similar amounts of manufacturing costs. Let's take a look at the different types of processes. So first we have sequential processing. This requires that units pass through one process before they can be worked on in the next process in the sequence. And then we have parallel processing. This is a processing pattern that requires two or more sequential processes to produce a finished good. Partially completed units can be worked on simultaneously in different processes and then brought together in a final process for completion. So regardless of which processing pattern exists within a firm, all units produced share a common property. Units are homogeneous and subjected to the same operations for a given process, and each unit produced in a period should receive the same unit cost. Job order and process costing are similar, but in process costing, each producing department has its own work in progress account. And as goods are completed in one department, they are transferred to the next department. And the costs attached to the goods transferred out are also transferred to the next department. So in an example, they'll give you a table with different departments, and for each department there are the direct materials, direct labor, and applied overhead costs. And this is assuming there's no beginning or ending work in progress costs. So essentially you'll add up the direct materials, labor, and overhead costs for that specific department, and then you'll get the cost transferred out of that specific department. Then you'll transfer that cost to the next department. And then for the second department, you'll add up the direct materials, direct labor, and applied overhead costs for that particular department and the cost transferred out of the previous department to get the total cost that will be transferred out from that second department to the next. So essentially, after adding up all the costs transferred out of all the different departments, along with the direct materials, direct labor, and applied overhead of the last department, you'll get the value of the finished goods. And this is what you calculate the unit cost based on. Something else they may ask you is to prepare the journal entries that reflect the cost transfers. To reflect this, you'll debit the work in progress account of the first department with the cost transferred out, and then credit the work in progress of the next sequential department or the second department. And then you'll do that again for the third department. You'll debit the work in progress account of the second department, then credit the work in progress account of the third department. And then lastly, you'll debit the finished goods account and then credit the work in progress of the last department. And this is the department that has the value of all the costs transferred out from each department. So something else we have in process costing is a production report, and this is similar to the job order cost sheet back in job order costing. So the production report is the document that summarizes the manufacturing activity that takes place in a process department for a given period of time. And remember, in process costing, costs are accumulated by department. So a production report contains information on costs transferred in from prior departments as well as costs. So in terms of service firms and process costing, to calculate the unit cost, it is the total cost for the period divided by the number of services provided. Let's talk about manufacturing firms using GIT, or just-in-time production. So firms that have adopted a GIT approach try to reduce work-in-progress inventory to very low levels. GIT firms usually structure their manufacturing so that process costing can be used to determine product costs. And to calculate unit costs for GIT firms, it's the total cost for the period divided by the total output for the period. And so the impact of work-in-progress inventories on process costing is that the unit cost is needed to calculate the cost of goods transferred out of a department and to value ending work-in-progress inventory, or EWIP. But then how should the costs of beginning work-in-progress, or BWIP, be treated? Well, we have the weighted average method and the FIFO method. In this chapter, we also have the concept of equivalent units of output or production. So equivalent units are the complete units that could have been produced given the total amount of manufacturing effort expended for the period. For example, let's say in October, 1,000 units were completed, and then another 600 were 25% complete. Then if we had to calculate the equivalent units for October, it'd be the 1,000 that were complete plus the 25% portion of the 600 that were complete. And then we'll get the equivalent units for that month. They can also call this an output measure. Let's quickly talk about ethical decisions in estimating completeness. So overestimating the degree of completion will increase the equivalent units of output and decrease per unit costs. This would cause an increase in income, so cost of goods sold will be less, and an increase in assets, work in progress cost will increase. So deliberately overestimating the degree of completion would clearly be in violation of ethical professional practice. So in an example, they might give you the manufacturing cost for the period, the units transferred out, and then the units in ending work in progress inventory. And then in brackets, they'll give you a percentage of which is complete. And they might ask you to calculate the unit cost. And to calculate this is the total manufacturing cost divided by the equivalent units. This means that we get the total manufacturing cost and we divide it by, for example, the 1,000 units that were completed or transferred out plus the 25% of the units in work in progress inventory that were completed. So to calculate the unit cost and essentially the equivalent units too, it's the total manufacturing cost divided by the units transferred out plus the percentage of units completed in the units in ending work in progress inventory. And now they may also ask us to calculate the cost of goods transferred out and the cost of ending work in progress inventory. So to calculate the cost of goods transferred out, it's the units transferred out multiplied by the actual unit cost that you calculated. And then to calculate the cost of ending work in progress inventory, it is the units in ending work in progress inventory, and this is the percentage that is completed multiplied by the unit cost that you calculated. But now let's take a look at the two methods of treating beginning work in progress inventory, or BWIP. And this is to calculate current period unit cost while taking into account prior period output and costs found in beginning work in progress inventory. So in terms of the weighted average cost method, which is the default, it combines beginning inventory costs and work done with current period costs and work to calculate this period's unit cost, or the current period's unit cost. The costs and work are carried over from the previous period and counted as if they belong to the current period. Beginning inventory work and costs are pooled with current work and costs, and an average unit cost is calculated and applied to both units transferred out and units remaining in ending work in progress inventory. And then we have the FIFO costing method, or the first in, first out costing method. This separates work and cost of the equivalent units in beginning inventory from work and cost of the equivalent units produced during the current period. Only current work and costs are used to calculate this period's cost. It's assumed that units from beginning inventory are the ones that are completed first and transferred out. The cost of these units include the cost of work done in the prior period as well as the current period costs necessary to complete the units. So the units started in the current period are divided into two categories. So the units started and completed, and the units started but not finished, so ending work in progress inventory. And the units in both of these categories are valued using the current period's cost per equivalent unit, or unit cost. And remember, if the product costs don't change from period to period, or if there's no beginning work in progress inventory, the FIFO and weighted average method yield the same results. So in an example, they can give you the units in process at the start of the month, which is the beginning work in progress inventory. They can give you the units completed and transferred out, and they can give you the units in process at the end of the month, which is the ending work in progress inventory, and then the percentage of them that are complete. In the same breath, they can also give you the work in progress cost at the start of the month, which is the beginning work in progress costs, and then they can give you the costs added during the month. If they ask you to calculate an output measure, they're asking you to calculate the equivalent units, which is the units completed and transferred out, plus the percentage of units in ending work in progress inventory that have been completed. And then they may ask you to assign costs to units transferred out and ending work in progress inventory using the weighted average method. So since we're using the weighted average cost method, we add the cost of the previous period to the current period's costs. So we add the costs at the beginning of the month, so the beginning work in progress cost, plus the costs added during the month. And this is how we get the total manufacturing cost for the period. And then we divide this total manufacturing cost for the period by the equivalent units we calculated to get the unit cost. And then to calculate the cost of the goods transferred out, it's the unit cost we calculated multiplied by the units completed and transferred out, which was given to us, 50K. And then to calculate the cost of the ending work in progress inventory is the unit cost multiplied by the percentage of the ending work in progress that has been completed. And then we get the total cost assigned. Now let's take a look at the 5 steps in preparing a production report. So the production report is a subsidiary to the work in progress account for a department. So the first step is the physical flow analysis, and its purpose is to trace the physical units of production. And you should know that the physical units are not the same as the equivalent units. They are units that may be in any stage of completion. So there are 2 calculations that are needed to construct a physical flow schedule. First, you need to calculate the units started and completed, which is equal to the total units completed, so not equivalent units, minus the units in beginning work in progress. And then you need to calculate the units started, which is equal to the units started and completed as calculated before, plus the units in ending work in progress inventory. And you should know that the total units to account for must be equal to the total units accounted for. So in an example, they'll give you the units in process at the start of the month, the units completed and transferred out, and the units in process at the end of the month. And then they could ask you to prepare a physical flow schedule. So first you'd calculate the units started and completed, which is the total units completed that they gave us, completed and transferred out, minus the units in beginning work in progress. Then you also need to calculate the units started, which is the units started and completed, plus the units in ending work in progress inventory. And this isn't the equivalent units in ending work in progress inventory, by the way. So the physical flow schedule is made up of 2 parts, the units to account for and the units accounted for. So under the units to account for, you'll have the units in beginning work in progress inventory, and this is the full amount, not just the percentage complete. And then you'll have the units started during the period, and you will have calculated this before. And then you get the total units to account for. And then under the units accounted for, you'll have the units started and completed, which is calculated beforehand. And then you'll also have the units in beginning work in progress inventory. And then lastly, you'll also have the units in ending work in progress inventory. This is the full amount, not just the percentage complete. Then you'll get the total units accounted for. And then the second step in preparing a production report is the calculation of equivalent units. So in the weighted average method, it treats beginning inventory units as if they were started and completed during the current period. Because of this, the equivalent unit schedule shows only the total units completed. So there's no need to show whether the units completed are from this month or beginning work in progress. The third step is computation of unit cost. So the weighted average method includes the manufacturing cost associated with the units in beginning work in progress inventory and counts these costs as if they are from the current period. So total manufacturing costs for the period, for example the month, is equal to the work in progress for the period plus the costs added in the period. And then the unit cost is equal to the total costs divided by the equivalent units for the period or for the month. So the manufacturing costs are carried over from the previous period and treated as if they were current period costs. And then the fourth step is the valuation of inventories. So the units completed, equivalent units in ending work in progress inventory, and the unit costs are all needed to value the goods transferred out and ending work in progress. And then lastly, the fifth step is cost reconciliation. And this checks to see if the costs to account for are exactly assigned to inventories. So the total cost assigned to goods transferred out and to ending work in progress must agree with the total cost in beginning work in progress and the manufacturing cost incurred during the current period. So now when preparing a production report using the weighted average method, you start off with the physical flow. And remember, under the physical flow schedule, we have the units to account for, which consists of the units in beginning work in progress and the units started. Then we also have the units accounted for, which includes the units completed and the units in ending work in progress. And then after the physical flow, you have to calculate the equivalent units. So you'll have the units completed during the period and then the units in ending work in progress. And this is the percentage of them that are completed. And then the last parts of the production report are the costs to account for and then the costs accounted for. So under the cost to account for, we have the beginning work in progress costs, then we have the costs incurred or added during the period. And then we get the total cost to account for. And then we get the cost per equivalent unit, which is the amount you calculated as the total cost to account for divided by the equivalent units you calculated. And then lastly, we have the costs accounted for. And under this, we have to add the cost of the goods transferred out. And we also have the cost of the goods in ending work in progress inventory. And remember, to calculate this, we need the unit cost and the equivalent units for each of the two. And remember, the total units to account for needs to be equal to the total units accounted for. The same with the costs. So the total cost to account for needs to be equal to the total costs accounted for. Now let's look at an evaluation of the weighted average method. So the advantages are that the unit cost calculations are simplified, and the units at beginning work in progress are treated as those of the current period, and all equivalent units belong to the same category to calculate unit costs. And now the disadvantages of the weighted average method is that there are inaccuracies in calculations of unit costs for current period output and for units in beginning work in progress. So the weighted average method is only accurate if the unit cost in a process is stable or consistent from one period to the next. But if the price of manufacturing inputs increases from one period to the next, the unit cost of current output is understated and the unit cost of beginning work in progress is overstated. Now let's talk about multiple inputs and departments. So accounting for production under process costing gets complicated because of non-uniform application of manufacturing units and the presence of multiple processing departments. So let's talk about non-uniform application of manufacturing inputs. So we assume uniform application of conversion costs, so direct labor and overhead isn't unreasonable. And then we have different percentage completion figures for manufacturing inputs. And then equivalent unit calculations are done for each category of manufacturing input, so materials or conversion cost. So in an example, they'll give you the units in process at the start of the month, and then the units completed and transferred out, as well as the units in process at the end of the month, or the ending work in progress, as well as the costs, right? You've got the cost at the beginning of the month for materials or conversion costs. So these are the two different departments we're dealing with. Then you have current costs, or the cost added during the month. So you have the cost for the materials department and the conversion department. So when you're calculating the equivalent units for different departments, we don't look at the overall equivalent units when given the cost categories. So we'll have materials and then we have conversion. Then under that, you'll have the units completed for materials and conversion, right? We assume that the units completed and transferred out are for both the materials and conversion. So we assume uniform application of conversion costs, so direct labor and overhead. And then under each specific department, you have the units in ending work in progress inventory that were completed. So for materials, it's not a conversion cost. So you put the full amount of ending work in progress completed there. But for the conversion department, so things that involve direct labor and manufacturing overhead, we record the percentage of the ending work in progress inventory that was actually completed. So essentially, you calculate equivalent units separately by each cost category or department, and you'll find that only 40% was actually converted to a finished good and attributed to conversion cost. So you'll put only 40% of the 20,000, for example. Then for materials, it's the full 20,000. So when you have to calculate unit costs, you have to calculate unit costs for each cost category. So assuming we're using the weighted average method, you have to calculate the total material cost and then divide that total material cost by the total equivalent units for that specific cost category. So remember, to get the total conversion cost or the total material cost, you get the beginning work in progress cost and you add the cost added. And then to calculate the value of ending work in progress inventory and the goods transferred out, you take the unit cost you calculated before and you multiply it by the equivalent units that you calculated before, but for each cost category or department. So to calculate the cost of goods transferred out, you have to calculate the total unit cost, which is the unit cost for one department or cost category plus the unit cost of the other cost category. And then you'll multiply it by the amount of goods transferred out. And the reason why we add the different unit costs is because these goods that were transferred out were both bought and completed or converted. Now let's talk about multiple departments and transferred in goods. So in process manufacturing, some departments receive partially completed goods from prior departments. So we usually treat transferred in goods as a separate material category when calculating equivalent units. So when dealing with transferred in goods, the cost of the material is the cost of the goods transferred out as calculated in the previous department. And the units started in the subsequent department correspond to the units transferred out from the prior department, assuming there's a one-to-one output measure for the departments. So in an example, they'll tell you how many units the company had in beginning inventory, as well as the transferred in cost associated with that inventory. They'll tell you how many units the company completed during the month, and they might tell you that one department, for example, the mixing department, completed and transferred out a couple thousand units at a cost of whatever. So when you're asked to prepare a physical flow schedule with transferred in goods, you start by calculating the units started and completed as well as the units started. So you start off with the units to account for, and under it you know it has the units in beginning work in progress as well as the units transferred in during the month from the mixing department or whatever department. So under the units to account for, you have the units in beginning work in progress and the units transferred in from another department. So one department transfers units and costs to another. And then under the units accounted for, you have the units started and completed. Then you have the units in beginning work in progress. Then you have the units in ending work in progress. Sometimes you may not have the units in ending work in progress, but because you calculated the total units to account for, you know that the total units to account for should be equal to the total units accounted for. So you can use that total figure to reverse engineer and calculate the units in ending work in progress. And then when they ask you to calculate the equivalent units for the transferred in category, you have to get the units completed plus the ending work in progress inventory multiplied by the fraction of which was complete. So you take the units completed, which is given to you in the example, then you add it to the ending work in progress inventory that was completed or that you've calculated. And remember, you had to reverse engineer to get the ending work in progress inventory. So to calculate the equivalent units for the transferred in category, you simply get the units completed plus the ending work in progress inventory and you get the equivalent units. Then they might also ask you to calculate the unit cost for the transferred in category. So to calculate the transferred in total cost is the transferred in cost from the previous department. So remember, in the example they said the mixing department completed and transferred out 60,000 units at a cost of $13,200. And then you have to add this cost that is transferred out of that department to the transferred in beginning work in progress cost, which was also given to us in the example. And then after you get the total, you divide it by the transferred in equivalent units we calculated before. And then we get the transferred in unit cost. Now let's take a look at making a production report using the FIFO method. So under FIFO costing, the equivalent units and manufacturing costs and beginning work in progress are excluded from the current period unit cost calculations. And now let's take a look at the differences between the FIFO and the weighted average method. So for FIFO, it's more accurate. So if the price changes of manufacturing inputs occur from one period to the next, it's more accurate. Then there's better cost control and there's better pricing decisions. But for the weighted average method, most firms use this method due to simplicity, and FIFO has little advantage to it if the unit costs are calculated for short periods. So FIFO assumes that units in beginning work in progress are completed first before any new units are started. For the units started and completed, the unit cost is calculated by dividing the total current manufacturing cost, so the cost added during the period, by the current period's equivalent output. So in an example, they might ask you to calculate an output measure for the month. So you know you have to calculate the equivalent units. So let's say the beginning work in progress units are 75% complete and there are 20,000 of them. The units completed and transferred out are 50,000 and the units in ending work in progress are 25% complete and there's 10,000. So when calculating the equivalent units using the FIFO method, it's the units completed and transferred out plus the remaining percentage of units in beginning work in progress inventory that you are going to complete during the current period. Now recall, 75% of the beginning work in progress inventory was complete, meaning the remaining 25% is what you're going to complete during the month. And then you need to subtract the units in beginning work in progress inventory holistically. So you subtract the 20,000. And then you also add the equivalent units in ending work in progress inventory like we usually do with the weighted average method. So the biggest difference when calculating equivalent units using FIFO is that you don't just calculate the units completed, but you also have to subtract the units in beginning work in progress inventory, which are assumed to be a part of the units completed and transferred out. And then you have to add the units of beginning work in progress inventory that you ought to complete during the month. And then you add the ending work in progress equivalent units. So in the example, they're going to give you costs of the work in progress at the beginning of the month, so the beginning work in progress inventory costs. Then they'll also give you the cost added during the month. Now, when calculating the unit cost and trying to value inventories, the total cost during the period that you're going to base your unit cost calculation on is the costs added during the month only. So in the weighted average method, we would add the beginning work in progress costs to the costs added during the period. But with the FIFO, we only use the cost added during the period to calculate unit cost and value inventories. So you'll divide the cost added by the equivalent units you calculated before. And then when calculating the cost of units transferred out, within FIFO, we assume that the beginning work in progress inventory are the first ones to be completed and transferred out. So when calculating the cost of units transferred out, you add the beginning work in progress costs, and then you add the beginning work in progress that you were going to complete, so the remaining percentage that had to be complete during this month. And then you add the cost of the units completed, or the units started and completed, which is essentially the units completed and transferred out minus the units in beginning work in progress inventory. So these are the ones that are actually started and completed in this month. So after adding these three things, you get the cost of units transferred out. And then the ending work in progress cost is essentially the unit cost you calculated multiplied by the equivalent units in ending work in progress. So when creating a production report using the FIFO method, the first step is the physical flow schedule. So it has two parts, the units to account for and the units accounted for. And under the units to account for, it consists of the units in beginning work in progress inventory, so not the equivalent units, and then the units started. And then under the units accounted for, it consists of the units started and completed, the units from beginning work in progress inventory, and the units in ending work in progress inventory. And then the second step is the calculation of equivalent units. So under FIFO, equivalent units in beginning work in progress aren't counted as part of the total equivalent work. Only the equivalent work to be completed this period is counted. So when calculating equivalent units, we only care about the percentage of beginning work in progress that wasn't completed. And then the third step is computation of unit cost. So only the current period costs or the cost added are used, and the cost of beginning work in progress inventory are excluded. And then the fourth step is valuation of inventories. So the ending work in progress cost is equal to the unit cost multiplied by the equivalent units in ending work in progress inventory. So under the weighted average method, the cost of goods transferred out was simply the unit cost multiplied by the units completed. But under the FIFO method, we have three things: the beginning work in progress costs, the to complete beginning work in progress costs, and remember, that's the percentage of the beginning work in progress that wasn't completed. And lastly, we also have the units started and completed. And the units started and completed is essentially the units completed and transferred out minus the beginning work in progress units, because we assume the beginning work in progress units are the ones that we transfer out first. And then the fifth step is cost reconciliation. So the costs assigned to production are reconciled to the total manufacturing cost to account for. So on the production report using FIFO, you'll have the unit information. So under the units to account for, you'll have the units in beginning work in progress, and then the units started during the period. And then after that, you'll have the units accounted for, and under that, you'll have the units started and completed. Then you'll have the units completed from beginning work in progress, then the units in ending work in progress inventory. So that'll have the physical flow and then the equivalent units on the side. And then you're going to get to the cost information, and then you'll have the cost to account for, and under that it consists of the beginning work in progress costs, then the costs added during the period, and then after that you'll have to put the cost per equivalent unit, and then after that you'll have the costs accounted for, and then this consists of the units in beginning work in progress, and then you have the units started and completed, then the goods in ending work in progress. Then you have a transferred out and the ending work in progress part. Now we move on to cost behavior with chapter 3. So cost behavior describes whether a cost changes when the level of output changes. So the cost can be variable, fixed, or mixed. And a cost driver is a causal factor that measures the output of the activity that leads or causes cost to change. For example, the number of units produced or the labor hours or machine hours, etc. But now let's talk about the relevant range. So the relevant range is the range of output over which the assumed cost relationship is valid for the normal operations of a firm. So it limits the cost relationship to the range of operations that the firm normally expects to occur. Now, what are fixed costs? Well, this is a cost that doesn't change in total as output changes, so it remains constant within the relevant range. And you should know that total fixed cost remains constant. So on a graph of the cost and the output on the x-axis, the fixed cost line is just a straight horizontal line. But the fixed unit costs decrease as output increases. So on a graph of the cost and the units produced, it's going to look like a hyperbola going down, like a swing. But you should know that there are two types of fixed costs. So we have discretionary fixed costs and committed fixed costs. So discretionary fixed costs are fixed costs that can be changed or avoided easily at management discretion. So they can be changed or avoided easily. For example, employee salaries or bonuses, research and development, donations, advertising and marketing, etc. And then we have committed fixed costs. So these are fixed costs that can't be easily changed. For example, rent or lease costs, loan payments, depreciation, taxes, utilities, insurance premiums, the use of the facility or infrastructure. Now we move on to variable costs. These are costs that vary in direct proportion to changes in output within the relevant range. For example, electricity or oil and supplies, etc. So these variable costs can also be represented by a linear equation. So y equals to a plus bx. Y is the total cost, a is the fixed cost, and then b is the cost per unit, and x is the number of units produced. And bx as a whole is the variable cost. And this is equal to the variable rate, the b, multiplied by the amount of output. And so basically the total cost is equal to the total fixed cost plus the total variable cost. So the variable cost increases in total as output increases. So on a graph, it's a straight linear line going up like the supply curve. But the variable cost per unit is constant. So on a graph, it's just a straight horizontal line. So straight line cost relationships are assumed within the relevant range, but they may actually be semi-variable costs. And we should be cautious when applying cost behavior assumptions outside of the company's relevant range of operations. For example, workers might take more time or use more materials at lower levels of output, but become more efficient as time goes on. And that's why the relevant range is so important. So now we move on to mixed costs. So these are costs that have both a fixed and a variable component. For example, manufacturing overhead of a company may consist of a fixed supervisor salary and the cost of supplies that vary with quantity of units produced. Or another example is salesmen's salaries. So they have their fixed salary per month plus the commission that they earn, and that's the variable component. Now let's talk about step costs or semi-fixed costs. So this cost displays a constant level of cost for a range of output, and then it jumps to a higher level of cost at some point where it remains for a similar range of output. So this is a discontinuous cost function. So in terms of step costs with narrow steps, it indicates that cost changes in response to fairly small changes in output. So if steps are narrow, they're classified as a variable cost. So with the cost on the y-axis and the number of units on the x-axis, the step cost with narrow steps you'll see has narrower steps, right? So after a small change in output, all of a sudden the cost rises, stays at that level for a little bit, and then rises again. And then in terms of step costs with wide steps, it means they're more characteristic of fixed costs. For example, a company leasing production machinery and each additional machine being able to produce an additional 1,000 units. So with the cost on the y-axis and the number of units on the x-axis, you'll see that the costs remain the same for a longish time and then go up a bit, and then stay at that level for a longish time, stay at that cost for a longish time, then go up a bit. But now let's talk about accounting records and the need for cost separation. So a formal effort is needed to separate costs and classify them into the appropriate cost behavior category. So if mixed costs are a small percentage of total cost, they could be assigned to either the fixed or variable cost category. And this can be done without concern for error or affecting decision making. Now let's talk about separating mixed costs into fixed and variable components. So there are three methods to separate mixed costs into their fixed and variable components. We've got the high-low method, the scatter graph method, and the method of least squares. Each method requires the simplifying assumption of a linear cost relationship. So from the equation y equals to a plus bx, we know that y is the total cost, which is the dependent variable. A is the fixed cost, which is the intercept. B is the variable rate, which is essentially the slope or the gradient. And then x is the output, and this is the independent variable or the cost driver, the one that causes or is closely related to the dependent variable. So when we take a look at the high-low method, we're given 2 points. And the slope, which is the B, and the intercept, which is A, can be determined. So you use the high and low data points. So the first step is to find the high point and the low point for a given data set. So for the Y, which are the costs, you find the highest cost and the lowest cost. And for the X, which is the output, you find the lowest output and the highest output. And then the second step is to calculate the variable rate, or the M or the B, the gradient or the cost per unit. And remember, you start with the highest volume. So the variable rate is the highest point cost minus the lowest point cost divided by the high point output minus the low point output, which is essentially the gradient formula. So change in y divided by change in x. So y2 minus y1 divided by x2 minus x1. And then you can also use the equation for a line. So y minus y1 equals to m multiplied by x minus x1. And you can substitute any point into the line equation. And then the third and fourth step is to calculate the fixed cost and form the cost formula. And then you can see what the variable cost is and what the fixed cost is from the cost formula. Let's take a look at the advantages and disadvantages of the high-low method. Well, the first advantage is objectivity. You arrive at the same answer, and it gives you a quick overview and the ease of use, so it's simple, inexpensive, and easy. The disadvantages are the occurrence of outliers outside of the relevant range, and the potential of misrepresentative data. Now let's move on to the scatter graph method. So this is a way to see the cost relationship by plotting the data points on a graph. And then you can inspect the scatter graph to see if it reveals outliers, and it may be justified to remove them. So you have X and Y. X is the volume or output and Y is the cost. So you plot the coordinates on a graph and you could see where the fixed cost is, the intercept. And you can also substitute the 2 points into the gradient equation to calculate the variable rate or cost per unit. But then the big disadvantage of the scatter graph method is the lack of objective criteria for choosing the best fit line. And then the advantage of the scatter graph method is it's simple and it's a visual representation of the data. And now we move on to the method of least squares. So this is a statistical way to find the best fitting line through a set of data points. So essentially they'll give you the results or output of a regression program. For example, they'll have the intercept, and remember this is the fixed cost. Then they'll have X variable 1. And this is the same as the variable rate or M or the slope or the cost per unit. And then you'll use the results to form a cost formula and calculate the costs. So the advantages of the method of least squares is that it's objective. It always produces the same cost formula for a given set of data. And the best fit line is the one that data points are closest to than any other. The disadvantage is that it's complicated and it's a lengthy process if done by hand. Now let's talk about managerial judgment. This is where managers simply use their experience and past observation of cost relationships to determine fixed and variable costs. So this is the most widely used method in practice. So the management may use experience and judgment to refine statistical estimation results. The advantage is its simplicity, and it can give good results if the manager has a deep understanding of the firm and its cost patterns. The disadvantage is if the manager doesn't have good judgment, errors will occur. Now we move on to absorption and variable costing with Chapter 8. So 2 methods of computing income have been developed to determine the performance of individual profit centers. So we have variable costing and full or absorption costing. So in terms of absorption costing, it assigns all manufacturing costs to the product. So direct materials, direct labor, variable overhead, and fixed overhead define the cost of the product. And the fixed overhead is assigned to the product through the use of a predetermined fixed overhead rate. And it isn't expensed until the product is sold, and the fixed overhead is an inventoriable cost. So absorption costing is essentially the normal income statement we all know. But then variable costing assigns only variable manufacturing costs to the product. So it only takes into account the direct materials, direct labor, and the variable overhead, so the variable part of manufacturing overhead. And the fixed overhead is treated as a period expense and is excluded from the product cost. In terms of inventory valuation, in absorption costing, the product cost includes the direct materials, direct labor, variable overhead, and fixed overhead. And obviously the period costs are the selling and admin expense. And then in variable costing, the product cost includes only direct materials, direct labor, and variable overhead. And then period costs here are not just the selling and admin expense, but also the fixed overhead. So in an example, to calculate the units in ending inventory, it's obviously the beginning inventory plus the units produced minus the units sold. And if they ask you to calculate the unit cost using absorption costing, it'll be the unit cost for direct materials, direct labor, variable overhead, and fixed overhead, so the overall manufacturing overhead, and then you divide it by the units produced. And that'll give you the per unit product cost. But now if they ask you to calculate the unit cost using variable costing, you'll get the unit cost of the direct materials plus the unit cost of the direct labor and variable overhead, and you exclude the fixed overhead unit cost. And then you'll get the cost per unit using variable costing. And usually the unit cost with variable costing is less than that of the absorption costing unit cost. So the only difference between the two approaches is the treatment of fixed factory overhead. The unit product cost under absorption costing is always bigger than the unit product cost under variable costing. So an income statement using absorption costing will look like the income statements we always do. So you'll have sales, cost of sales, gross profit, and then you'll less the operating expenses. So the selling and admin, and then you get the operating income. But then in variable costing, the income statement looks different. So first you have to calculate a sales amount using just the direct materials, direct labor, and variable overhead as the unit product cost. So it's sales, and then you less the variable expenses. You subtract the variable cost of sales, and then you get the contribution margin. And then after getting the contribution margin, you'll then less all the fixed expenses. So you'll subtract the fixed overhead and then the fixed selling and admin expense. And then you'll get your operating income. So you should know that if production is larger than sales, so if the units produced are larger than the units sold, then absorption income will be larger than variable income. But then if production is less than sales, then variable income will be larger than absorption income. So managers can expect that as sales revenue increases from one period to the next, income should also increase, all other things being equal. And as sales revenue decreases, income should also decrease, all other things being equal. And if sales revenue remains unchanged, then the income should also remain unchanged. So variable costing ensures that the above relationships hold. However, absorption costing may not. Now let's take a look at preparing segmented income statements. So a segment is a subunit of a company of sufficient importance to warrant the production of performance reports. And these segments can be divisions, departments, product lines, customer classes, etc. So in segmented income statements, fixed expenses are broken down into two categories: direct fixed costs and common fixed costs. So direct fixed expenses are fixed costs that are directly traceable to a segment. So they're sometimes referred to as avoidable or traceable fixed expenses. This is because they vanish if the segment is eliminated. For example, rent for the sales office for every sales region. And then common fixed expenses or indirect costs are jointly caused by two or more segments. So it's a fixed expense for multiple departments. And allocations aren't useful in evaluating the segment's profitability. So these expenses persist even if one of the segments to which they are common is eliminated. For example, depreciation on the corporate HQ building or the salary of the CEO. So in terms of the format of a segmented income statement, you have sales at the top, and then you less or subtract all the variable costs. After which you get the contribution margin, and from there you less or subtract all the direct fixed costs. After which you get the segment margin, and from there you subtract all the common fixed costs, and then you'll get the operating income. So it's similar to the variable costing income statement, but now we separate the fixed costs even further. So in an income statement, you might have sales, and then you'll subtract the variable cost of sales, and then the variable selling expense. Then you'll get the contribution margin. From there, you subtract the direct fixed expenses, so the direct fixed overhead and the direct selling expense. Then you'll get the segment margin. And from there, you subtract the common fixed expenses, so the common fixed overhead and the common selling and admin expense. Then you'll get the operating income for each product line. And then you'll usually put the totals for the common fixed overhead and common selling and admin expense on the total side column. So separating the direct fixed costs from the common fixed costs and focusing on the segment margin will give a truer picture of the segment's profitability. Now we move on to cost volume or break-even profit analysis. So what is cost volume profit analysis, a CVP analysis? Well, it estimates how changes in three factors, so cost, sales volume, and price, affect a company's profit. CVP analysis helps them reach important benchmarks like break-even points. But what is break-even point? Well, this is the point where total revenue equals to total cost. So it's the point of zero profit. So this is the level of sales at which the contribution margin just covers the fixed costs and when the operating income is equal to 0. So CVP analysis helps address the number of units that must be sold to break even, the impact of a given reduction in fixed costs on the break-even point, and the impact of an increase in price on profit. So, but then what is contribution margin? Well, it's the difference between the sales and variable costs and the amount of sales revenue left over after all the variable costs are covered that can be used to contribute to the fixed costs and the operating income. So contribution margin is essentially sales minus all variable costs. And you should know that the operating income is equal to the sales minus the total variable expenses minus the total fixed expenses. And to break it down even further, the sales is the price multiplied by the units sold. The total variable expenses is the variable cost per unit multiplied by the units sold, and then minus the total fixed expenses. But then how do we calculate break-even units? Well, break-even units is equal to the total fixed cost divided by the contribution margin per unit, or it's equal to the total fixed cost divided by the price minus the variable cost per unit. So you can use both methods and you'll have to see what they give you in the example. So in an example, if they ask you to calculate the variable cost ratio, it's equal to the variable cost per unit divided by the price. Or it could be the total variable cost divided by the sales. And then you'll get a decimal or a percentage. And then in order to calculate the contribution margin ratio, it's the contribution margin per unit divided by the price. Or you can just get the total contribution margin divided by the sales. So, but then what is the relationship of fixed cost to contribution margin affecting the operating income? Well, there are three possibilities. The fixed cost could equal to the contribution margin, and this means the operating income is equal to 0 and that the company breaks even. Then the fixed cost could be less than the contribution margin. So the operating income would be larger than 0, so positive. The company makes a profit. And lastly, the fixed cost could be larger than the contribution margin. So the operating income is less than 0, negative. The company makes a loss. So how do we go about calculating the break-even sales? Well, this is equal to the total fixed cost divided by the contribution margin ratio. Not to be confused with the contribution margin per unit with the break-even units. You can reverse engineer and calculate the break-even sales by multiplying the break-even units with the price. So now we move on to calculating the units that need to be sold to achieve a target income or profit. So the units to be sold to achieve a target income or profit is equal to the total fixed cost plus the target income divided by the price minus the variable cost per unit. Or it could be the contribution margin per unit. So it's the total fixed cost plus the target income or operating income that you want to achieve divided by the price minus the variable cost per unit. But then what about the sales revenue to achieve a target income or profit? Well, this is the fixed cost plus the target income divided by the contribution margin ratio, not the contribution margin per unit. So the sales revenue to achieve a target income or profit in dollars is the fixed cost plus the target income divided by the contribution margin ratio. And again, you can also reverse engineer and multiply the units to be sold to achieve a target income or profit by the price. And this is to get the sales revenue to achieve a target income or profit. So how do we assess the impact of a change in revenue on change in profit? So assuming the fixed costs remain unchanged, the contribution margin ratio can be used to find the profit impact of a change in sales revenue. So change in profits or change in operating income is equal to the contribution margin ratio, which is a decimal, multiplied by the change in sales. For example, if sales revenue drops from $440,000 to $400,000, the change in sales is $40,000. So a profit volume graph shows us the relationship between profits or operating income and the units sold. So it has the profit or loss on the y-axis and the units sold on the x-axis, and it's a linear line going upward, and then where it cuts the x-axis is the break-even point. So what are some of the assumptions of cost volume profit analysis? Well, it assumes linear revenue and cost functions remain constant over the relevant range. It also assumes selling prices and costs are known with certainty. It also assumes all units produced are sold, so there are no finished goods in inventory. And it also assumes the sales mix is known for multiple products. So now we move on to multiple product analysis. So the sales mix is the relative combination of products being sold by a firm. So in an example, they could say that a firm produces 13,500 DVDs and 4,500 equipment sets. You'd essentially have to find the simplest ratio between these two. So you'll say 13,500 to 4,500 and divide both sides by 4,500. to get a final ratio of 3:1. Now, if they say it goes as a package, then you'll have to add up all the prices and variable costs of each of the products in the package. And then you'll get the variable cost or price of the package as a whole. And you can use that to calculate the price of each package and the contribution margin per package. And then if you need to calculate the break-even units for a package, then it's the total fixed cost divided by the contribution margin per package. So when given multiple products, how do you go about calculating break-even units for a specific product? Well, you'll have to calculate the total fixed cost divided by the weighted contribution margin per unit. So if the ratio of DVDs to equipment sets is 3:1, then essentially you'll calculate the contribution margin per unit for each individual product and then multiply it by the ratio. For example, for DVDs, it'd be multiplied by 3/4, and for equipment sets, it'd be 1/4. So it'd be the total fixed cost divided by the contribution margin per unit for that specific product multiplied by its ratio added to the one for the other product. And then you'd get the overall break-even units. Then to calculate the break-even units for that specific product, it's the overall break-even units you calculated multiplied by the ratio for that specific product. And now we move on to the margin of safety. So the margin of safety is the units sold or the revenue earned above the break-even volume. So it's the minimum sales to break even or avoid a loss. So the margin of safety or MOS is equal to the sales units minus the break-even units. Or if you want to calculate it in sales dollars, it's equal to the current sales minus the break-even sales. So now let's talk about operating leverage. So operating leverage is the measure of the proportion of fixed costs in a company's cost structure. So it's the mix of fixed costs relative to variable costs. So this is the use of fixed costs to extract a higher percentage change in profits as sales activity changes. So the greater the degree of operating leverage, DOL, the more changes that will affect the operating income. And the DOL, or the degree of operating leverage, is used as an indicator of how sensitive profit is to changes in sales volume. So to calculate it, the degree of operating leverage, DOL, is equal to the contribution margin divided by the operating income. So this is the total contribution margin divided by the operating income. And you'll get a decimal. So sometimes in an example, they might give you the degree of operating leverage and also the percentage change in sales. So instead of calculating the change in profit as the contribution margin ratio multiplied by the change in sales, in this case you'd have to use the degree of operating leverage, the DOL. So the change in profit would equal to the DOL multiplied by the percentage change in sales. Then you'll get a decimal or a percentage, and you can use that to calculate the expected sales given the increase in sales. Now we move on to profit planning with Chapter 9. So what's a budget? Well, these are financial plans for the future and are a key component of planning. They identify objectives and the actions needed to achieve them. And then the strategic plan plots a direction for an organization's future activities and operations, and it generally covers at least 5 years. So what are the advantages of budgeting? Well, first is planning, and then it also gives us information for decision making. It gives us standards for performance evaluation, and lastly, it leads to improved communication and coordination. So, but what is the master budget? Well, this is the comprehensive financial plan for the organization as a whole. So it's typically for a 1-year period corresponding to the fiscal year of the company. And these are yearly budgets that are broken down into quarterly and monthly budgets. And you should know that the use of smaller time periods allow managers to compare actual data with budgeted data more frequently, and so problems may be noticed and resolved sooner. And then a continuous budget is a 12-month moving budget. And you should know a master budget can be divided into both the operating and financial budget. So the operating budget describes the income generating activities of a firm. So sales, production, and finished goods inventory. And then the financial budget details the inflows and outflows of cash and the overall financial position. So the cash budget is the planned cash inflows and outflows. And then the sales budget describes the expected sales in units and dollars. In an example, they may give you the budgeted units to be sold for each quarter of the year. Then they'll also give you the selling price for each of these units. And to calculate the budgeted sales for each quarter, you'll have to multiply the budgeted units to be sold by the selling price per unit. So from the sales budget, we move on to the production budget. So this shows how many units must be produced to meet sales needs and to satisfy ending inventory requirements. So the units to be produced is equal to the expected unit sales plus the units in desired ending inventory minus units in beginning inventory. So it's the budgeted unit sales plus the units you want in ending inventory minus the units in beginning inventory.